We're live on YouTube, Facebook, Twitter, probably a bunch of other places too. I'm not even sure anymore. Anyway, we're live. Thanks for joining us. Hopefully, everyone had a wonderful weekend. And let's see, let's get started here. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host. I'm once again joined with my good friend Doug Hagren. Hey, Doug.
Happy Monday, Kirk. I guess I always say this like for things like Passovers. Happy Passover. And they're like, well, it's not really happy. And the same thing. It's like it's 9/11, right? So I don't know how you greet that. It's not happy, but it's definitely an important day in American history, and may we never forget. So
Yeah, I totally spaced on the fact it was September 11th. So yeah. All right. Well, let's dive right in. Let's start this show on a good note to make up for the other stuff. All right. Let's dive right in. So actually, this week I want to go over a bunch of stuff, and one of the things I want to talk about is the fact that the markets have had a good year, and if you look at the markets from the perspective of, hey, let's look at the headline number and see how they're doing, then you might think, hey, it's glorious. Everything's great, right? The NASDAQ's up 5,000%. I forget what it is exactly. It's probably 30 something at this point. The S&P 500 is up, I think, somewhere around 15%. Um, we converted from TD over to Schwab, and still some of our stuff isn't working. So, we still don't have access to all the stuff we normally do, but that's okay. But I did want to point out a few things. So typically we look at index, like everyone looks at the index and they say, oh, what's the index doing? I want to compare it to the index. And that's a good marker, but that should not be your comparison. And I'll give you a few perspectives why. Now, if you are investing in a broad spectrum of stocks, then the S&P 500 may be a good index. Now, if you have large cap, mid cap, small cap, international, emerging markets, well, the S&P 500 is not a good comparison, right? Each one of those areas has its own index. And if you're comparing it to that index, then that's a good marker, right? But if your portfolio is 60% stocks and 40% bonds, you should not be comparing yourself to the S&P 500. I just want to make this abundantly clear. Every single person out there, well, that's a too broad brush of a stroke, but most people out there, their gut reaction is, what's the S&P 500 doing? Why am I not getting that return? Maybe because you shouldn't be comparing yourself to the S&P 500, right? It's like comparing yourself to a cat and saying, well, why can't I land on all fours when I fall? It's just you're not a cat, right? So if you're investing in bonds, then you shouldn't be comparing yourself to the S&P 500. Now, there might be a piece of your portfolio that is invested in equities in a similar allocation. Okay, then it is a good comparison, right? But if you own emerging markets, you shouldn't be comparing that to the S&P 500 because it's apples and oranges, right? So think about your portfolio and what you own and try to find an index that is a comparable one, right? Assuming this is one way to mark your performance. I'm not even saying it's the best one. I'm just saying it is a normal one that people look at, right? So if you're trying to compare how you're doing this year, then what do you look at? Well, one way is relative. How is it performing relative to everyone else or the index or the market, right? You pick a metric and you say, how is it performing relative to that metric? Now, if your metric is the S&P 500, then how are you doing relative to the S&P 500? Now, over long periods of time, Warren Buffett would argue that you're never going to outperform the S&P 500 because there's always costs involved, and the costs will eat away at your performance, and you're not going to beat the average over time. That is his hypothesis. However, he has beaten the S&P 500 over time, and so I would argue that his hypothesis is not exactly correct, right? So if you're an indexer, you could say, well, why has Warren Buffett outperformed over decades of his life? Maybe indexing isn't the best approach. It's not a bad approach, right? It's just if you're trying to outperform the index, it's possible to do that. Is it probable? Maybe not. right? Because you're not Warren Buffett, neither am I, neither is Doug, right? Unless, Doug's moonlighting as Warren Buffett in Vegas. But outside of that, you have to look at what is your comparison. Now, relative is one, another is on an absolute basis. You might decide, I want to make 5% a year or 10% a year. Okay, that is on an absolute basis. Your target is 5% a year. Well, if your target is 5% a year, then you should be trying to hit 5% every year, year in, year out, right? Now, if right now US Treasury is earning 5%, then you should be able to target to make that pretty easily. But if you're investing in equities, maybe that's the best way, maybe it isn't, right? You have to make these determinations. Now, if you're investing in uh, hard money loans or private mortgages, or goes by many names, um, if you're investing in that area and you're able to get 10 to 15% a year and consistently year in, year out, then okay, maybe that's your target. You can do that, but there's some expectations built into that, right? If you make an error, maybe you lose a little bit, but your variability between 0 and 100 is going to be very small, right? It's going to be maybe somewhere between 8 and 12 if your target's 10. So the variability is going to be a lot smaller because you know what you're going to get. The upside is more or less capped, and your downside is pretty much how well you do your due diligence and how well your notes perform, right? So the variability is a lot small. Um, and so you need to figure out what is your comparison. And you need to make sure your comparison is realistic. Because if your comparison is, I want to make 10% a year on an absolute basis, and you're relying on the market, well, maybe that's not the best comparison because historically 10% is kind of high. Um, so you want to make sure it matches up, right? And if you're all in bonds and they're earning 5%, you're trying to get 10, maybe that's not matching up, right? So you need to make sure it's whatever you're trying to achieve is achievable, right? And I think this is really important because people just come up with numbers out of thin air and say, I want to do this. Okay, what is your process to get there? I don't know. I wish it, so it be, right? And I think that's how most people invest. It's like you're trying to wish it into existence, right? Um, and you know, hoping for return is not a strategy, right? We talk about hope is not a strategy. It's really important to understand that because most people invest with hope. They just invest and hope it goes up. And they have no idea how the inner workings of things go. It's like going to the casino and hoping you win. Well, if I don't know how to play the game, my odds are going to be a lot less than if I know how to play the game. And even then, my odds are still less than 50-50. So hope is not a strategy. I think we can all agree with that. But here's why I'm explaining all this, because I want to point out something really important. Now, the economy itself is driven by many, many, many different companies, some of which are public, some of which are private. Private companies like your plumber, your electrician, your local attorney, your advisor, people who don't run public companies. They still have a company, they still generate revenue, they still employ people, all those things. They're still companies, but they're just not Fortune 500 companies. They're not S&P 500 companies. They're not publicly traded, right? They're private, right? So there's no market for them. Now, if you look at the S&P 500, it's made up of 500 companies. And of that 500 companies, each one has a weighting based on the size of that company. So the smallest of the 500 gets the smallest weighting, and the largest, I think it's still Apple, gets the largest weighting, right? So Apple might have, and I'm just guessing, it might have 5% of the S&P 500. Whereas, Acme Corp, I don't know what the smallest one is. Let's say it's Acme Corp is the smallest one. They might have 0.001% of the S&P 500, right? There's a range. So what tends to happen is the largest companies tend to perform better than smaller companies. That means the index is going to go up more, right? So let's say, for example, let's use a live case study. Okay, I'm going to bring up a chart here and show you this year, and you can see what I'm talking about. So for those of you online live, you'll be able to see this. If you're not live, go to the website, go to the replays, and you'll be able to see this. So this is something I got from Goldman Sachs Investment Research. That's the source of this. And this is this year. This is the performance of the top mega cap tech stocks. This is the top 7 names. of those top 7 names, according to Goldman Sachs, for this year to date, it is up about 54%. And it's, mind you, most of it's NVIDIA because NVIDIA is up like 100 some odd percent. But these 7 stocks make up 54% return this year. If you had nothing but these stocks, that's a pretty good performance for any year. Now look at the S&P 500. Well, it's up about 15. Well, let's remove those 7 and let's see what the performance is of the remaining 493 companies. So this is 99% of the S&P 500 is up 4%. Only 4% for the year. Amazing. So 99% of the S&P 500 is up 4%. And 1% is up 54% this year. And that means the S&P 500 is up 15 in total. That's really weird. Okay. And I mention this not because really, I'm not really for any reason other than to point out the absurdity of what's going on here. Okay. And you need to understand this because if you think the market is doing great and everything's awesome, then you're in for a surprise because the market is not doing great. It's not doing awesome. The index is doing great and awesome this year, up 15%. Wonderful. And big tech doing wonderful this year. Everyone else, not so much. So for those of you who are trying to understand why the market's up and some of the news is down and interest rates are up and what's going on here, well, this is why the market is really not up all that much. 7 stocks are up, but the rest of the index is only up 4%, which means this ties into our thesis that we've been talking about of the market is going to be doing a whole lot of nothing for a while. It's going to do a lot of sideways motion. And this is basically what's been happening. Now, last year was a mess, I think, for everybody, and not going to argue that. But going forward, we're going to have this muddle through economy. And I cribbed that from somebody else. I think it was, I forget who offhand, but a lot of people have been saying it. It's this muddle through economy where things are just chugging along. They're not really advancing, they're not really declining. It's just kind of messy in the middle. And that's what we're seeing. And I think we're going to continue to see that for a while. This fall, we're heading into September and October, which are 2 of the messier months. If you see a big sell-off or a crash, they tend to happen in October. September, October tend to be a little soft. This year, an election year, tends to be pretty strong, which we're seeing in the index. But I think you should expect not much further upside from here. Now, I will mention this, and I'm going to hand it off to Doug real quickly. That one thing I started to see in the last 2 weeks, and I don't watch mainstream media, right? I have my own feeds of news that I get and subscribe to and follow certain people, and I've cultivated that over years. So I know what I'm getting and the quality, and I can look at a news and see who it's from and say, all right, this is good or bad, or here's their bias. So it helps me configure the world. Now, what I've been seeing in the last 2 weeks is negative, negative, negative. Negative earnings, negative earnings, negative earnings, lots of negative earnings announcements, just all in a row. Like I've seen days where there's nothing positive in the news. And I don't mean the news. I mean like my feed of like earnings reports and whatever. I'm just like, what's going on here? Like it's just like a obviously negative trend that is starting. Now, what I think might happen based on this is that we'll start to see a lot of companies dump their bad news into this quarter or this coming quarter. So what tends to happen is what companies will do in the US, more so than other countries, is we'll take bad news and we'll dump it into one quarter. So if the markets sell off harshly, oh, the market's coming, oh, this is going on, everyone will just dump all their bad stuff because they hide it in like this tidal wave of crap. And they figure, well, everyone else is doing it, might as well do it too. And they dump all their bad news. Even bad news hasn't happened yet, may not happen. Oh, yeah, it's terrible, it's terrible. So what happens is we're like, well, the market expected it. We told you, right? So they get rid of all the bad stuff. And then when the market rebounds, they're like, oh, everything's great. It was so much better than expected. Well, the expectations stunk, but you're still better than expected. And that's all the market's looking for. So we may start to see that. I'm starting to see some green shoots or brown shoots in this way. We're starting to see some tendencies that may happen this quarter. Certainly, we don't know because earnings are coming up, but I'm starting to see a lot of evidence that companies are like, yeah, this isn't good. We're not seeing a lot of good stuff going forward. You know, we had the biggest company in the world, Apple, come out a few weeks ago and provide some bad news. with future prospects. So, I think it's just something to be aware of, that we're starting to see some bad stuff come out, and I think you should just understand that if you think the market's just going to straight shot up from here, I think you should probably be a little more cautious than greedy. If you've been in the index all year, you've done great. Nothing wrong with taking little profits off the table and sitting the sidelines. I think the market's gone up way too fast, way too quick, and I think we're going to see a little bit of a slowdown. So, Doug, what are some of your thoughts?
Well, one of the things I was looking at while you're running those is if, they're saying 54% for Meta, Amazon, Apple, Microsoft, Google, Tesla, NVIDIA. If you streamline that down a little bit further, Tesla, you're right. I mean, NVIDIA is up 205% year to date as of this moment. And there's been some movement since that chart was made, because now the S&P is up a little bit, close to 17%. Tesla's up 114%. Now, if you take the rest of them, they're all right around 30, 40, 50, 60%, which is amazing on all of them. But listen, let's take this down even more granular. It's really two stocks that drove that, because if you took out NVIDIA and you took out Tesla, which, by the way, is not having a great year as a company, but yet the stocks go into the moon, you would probably be seeing the S&P 500 even closer to that 4%, probably under 10 without those two stocks. So I just an incredible amount of impact based off of two stocks. And I mean, obviously, 7 stocks there, but 2 stocks really carrying the bulk of it. And we're starting to see that kind of dip back here as of late. The other thing, too, is just taking a look at, like you just said, if you have a 60-40 portfolio, and again, it comes back to, unfortunately, and again, you didn't want to generalize. I don't want to generalize, but for the most part, people are just generally never happy. They are either not making enough when they compare themselves to others, or they're losing too much when they compare themselves to others. And it's a very human based emotional response. I mean, a gentleman I listened to kind of talked about this in the coaching world. I said, you know what? The squirrel never looks at the other squirrel and says, well, he's got more acorns, right? This is a very, very human emotional response to look at this with envy. And that's what we're doing with our portfolios. We're looking at as envy, right? We're saying, hey, I should have done better, or either not losing as much or making more. And that unfortunately creates some really big mistakes that people do in terms of managing. It's like, well, you're not making me enough, so I'm going to make a switch here and go to someone else who's going to do the same thing in the portfolio, and you're going to consistently run into disappointment unless there's a strategy and an explanation and an understanding as to what you're trying to accomplish. And if there is a methodology like Warren Buffett uses that again is disciplined and consistent, and it may not always win, but again, it's an expertise that goes into an application that over the long run will. Unfortunately, these short-term worlds and the way indexes work, what people are faced with is constant onslaught from the media, like Kirk was saying. And this constant onslaught is continuously telling you why you should have done better or worse. It's an emotional response. Remember, these news companies are not there to sell news. News is actually an expensive byproduct. And as we've seen, depending on what channel you're looking at, a lot of these really expensive news or talking heads, I wouldn't actually call many of these people news anymore, they're getting let go because nobody wants to pay it. In other words, the people that you go and listen to, they're an expense. They are overhead. We are not in the business. They are not in the business of selling you news. They're in the business of selling advertising. By the way, there's a few on that list there, such as Alphabet/Google is one of those big advertising companies. Meta, big advertising company. And they are in the business of selling to advertisers that they're getting the views. And what gets the views? It gets the views, emotion. But guess what's really, one of the things that's done incredibly well year to date, I mean, in comparative, it's kind of right there in those stocks, is Bitcoin. Okay. But the media constantly sits there and talks about how the market's doing and uses the S&P 500, which we've just identified is 500 stocks, of which 7 are really carrying the weight, and maybe even 2. Okay. Nobody would look at their portfolio and say, well, I'm not getting as much as Bitcoin. And I'm not saying that people aren't out there wondering if they could have Bitcoin and want Bitcoin, but comparing, like Kirk was talking about, a more tempered portfolio of emerging markets and large caps and small caps and bonds, whatever. He used the generally accepted long term, although highly debunked 60-40, right? If that's your possible portfolio, how can you possibly look at the S&P 500 and think that's a valid benchmark? It's not. It's 100% equity. You don't own 100% equity. So why am I not getting that? Well, we can put you at 100% equity, but sign this right here telling me you won't be pissed off when the entire market goes down 50%. By the way, the S&P 500 is still down over a 2-year period. So it looks great this year, but it's still down about 8% for 2 years. It hasn't come back. So when we start looking at that, you got to take both sides of it, right? And that's why allocation matters. That's why risk tolerance matters. And that's why the S&P 500 makes a terrible benchmark. The same way someone wouldn't be saying, why is my portfolio not doing as good as Bitcoin? Well, because inherently Bitcoin isn't the stock market. It's a nice thing to hold. Maybe you wish you had all of it, but the media doesn't use Bitcoin as the benchmark. Again, you could switch this whole thing up and say, hey, Kirk, why don't we just compare all portfolios to the emerging markets? Well, that wouldn't go over really well because emerging markets, I think, as an asset class, I'm looking at, roughly down maybe, about break even for the year and really down for 2 years. Nobody would like that, right? But it would make you look really good with your 60-40 portfolio. Nobody would be complaining. But the problem, as Kirk said, it's perspective. And it is incredibly important for you to understand that if you're going to compare what you're holding, you have to compare it to a benchmark that complements and is equal to what you're holding. And then you can look and relative say, okay, is my value investment doing as well as value investments? If it is, check. Is my large cap doing as well as large cap? If it is, check. If my emerging markets has lost money, but is emerging markets lost money? Okay, check. And then you might say, well, why am I holding emerging markets? I don't want to lose money. This goes back to what I have said. I don't know ad nauseum, Kirk. You could probably count up the number of times I've said it. If you don't dislike something in your portfolio, you're not diversified, right? We don't know. I mean, emerging markets and value have been dogs for a long time in the relative scheme of investing. But there's also been windows in which they were absolutely the greatest holding in a portfolio. And none of us know when that's going to turn. If so, I wouldn't be here. I'd be too busy polishing off the crystal balls that I sell probably on Amazon, helping their stock go up. So anyway, I'll turn it back to Kirk. So, we can go in a different direction. But again, this is the biggest issue with investors. They have no perspective in general. Maybe you listening do, and they have no patience. And at the end of the day, they really struggle with greed. And you got to get rid of the greed side of it because greed is what will take you down.
Yeah, totally agree, Doug. And I'm gonna touch on one thing. Just talks a little bit about numbers and statistics, which I'm not gonna put people to sleep, but I think you'll enjoy this. So one more line along what we were talking about. I think this year around 75% of the entire Nasdaq's gain came from those 7 stocks. 75% of the gain. So meaning the rest of the Nasdaq's not doing so well. And what I think is happening, and this is just a little more backstory into why. Right? Why things are doing what they are. So you're probably asking, well, why are only 7 stocks doing all this? Well, I think part of the reason is what investors saw last year is they saw reality. And what they realized is, well, all these tech stocks, they don't make any money. I don't want to invest in a company that doesn't make money. And, they've been doing that for decades, right? Oh, let's invest in stocks that don't make any money because somewhere down the road, they will make money. I think it's the most absurd thing ever. But it is what it is. And these companies, they grow and they make a lot of good stuff and they make our world better. Not knocking them, just saying like people have different perspectives. Some people invest in cash flow. Some people invest in pipe dreams. You invest in one pipe dream and it goes to the moon. You can make up for all the wrongs that you had there. So, but I wanted to show this chart because based on the numbers that we just saw, this chart is actually from FinViz, great site for visualization if you're a visual guy like myself or girl, not just guys. So we just talked about the numbers.
Or non-binary, Kirk. Let's include everybody now. Just making sure.
Yeah, that's you can include that, Doug. I don't have that many disclaimers under this, so we'd be here all day. So think of it this way, right? We just talked about how the S&P 500 of those 7 stocks up 54%. Now, mind you, Doug pointed this out. 54%. Now Microsoft's only up 40, which means it's dragging down the 54. Apple's up 36, it's dragging down the 54. So you pretty much have Amazon, Tesla, Nvidia, Meta, obviously huge, and Google's right around 54. So you have a handful of stocks that are really driving it. I mean, Tesla's up huge, Nvidia and Meta's up huge, and the other ones are just moderately up, only 50, 60%. But the point being is, if you look at the numbers, even that is spread out. Now, I also wanted to point out that the rest of the market, right, not just those seven, but the rest of the market exists too. So if you look at healthcare, except for Eli Lilly, not doing all that great. If you look at most of the sector, not doing all that great. Energy, just very moderate returns, similar to the non big tech related index. Basic materials doing okay. Utilities are doing terrible, which we would expect with higher rates. You get into the financials. You know, there's obviously some companies, the two credit card companies, as well as Berkshire, look like they're doing well, but a lot of the financials are not, right? Which we would expect, right? Higher interest rates, inverted yield curve should be negative for the index. Now, I want to actually point out one other thing. I've been hearing this a lot lately, and it makes the rounds, right? It started making the rounds about a year and a half ago when it started, and it stopped for a while because people were like, well, I don't know what's going on. It's starting to make the rounds again. So people are looking for something to chirp about. And what I'm talking about is the inverted yield curve. Now, people throw this stat out once the yield curve inverts, and then at first they start to argue: is it the 2 and 10? Is it the 1 and 3? Like which yield curve are you talking about? And the statisticians were arguing back and forth. Who cares, right? The fact is, it's an indicator. It's not 100% accurate, so it's an indicator. It's like, yeah, maybe it's true, maybe it isn't. I don't know. But the point is people were using it, and they said it's undeniable. History, statistics show that every single time we've had an inverted yield curve, it's led to a recession. But we haven't had a recession yet, at least according to Joe Biden. I think many would argue that the recession happened last year, but let's not mince words. The fact is things are still rough, and it's still inverted, right? Because typically what happens is, if you look back at history, the yield curve will invert, and then it'll come back to normal. The markets will crash, and then they'll come back, right? But the inverted yield curve stopped well before that happened. We are still inverted, right? It's been a year and a half. It's crazy. It's still inverted. And is that going to continue? I don't know. But I can tell you this, that the fact that it's still inverted is weird, because I don't recall it. It may have happened before, but I couldn't find it. And that alone tells me that something's wrong. Really, and here's the thing. I asked this one of the guests, and it hasn't come out yet, so you haven't heard this yet. So I'm gonna preempt this a little bit. So I asked one of my smarter guests. I said, "Look, we have the inverted yield curve. Historically, it's the sign of a recession. Within, I think, 18 to 24 months, statistically, is when you'll see it. Which means we still have a little time before we could see the recession. Which means probably sometime in the next 6 months. Anyway, that aside, you have an inverted yield curve. Why does that lead to a recession? Historically, if you think about the logic, and I have not gotten a good answer, by the way. I've asked people that are typically the brightest in the room, and not many actually have an answer. They're just like, well, it's just a statistic. Like, we don't put a lot of credibility. We look at it and say, well, it's pretty accurate. It's a correlation, not necessarily a causation. But I try to take it a step further. Is there a causation? Can we find one? Well, generally, probably not, because that's how statistics in the markets work. But if I had to think of one, it would be that an inverted yield curve means that financial institutions are not making money. So when you have a normal yield curve, what happens is the financial institutions will borrow in the short end and lend in the long end, right? So basically, they'll borrow at 2% and they'll lend at 4%, and they'll make 2% spread. That is typically how they make money. That is how a lot of financial institutions make money. Now, what you can look at is and say, all right, as long as the yield curve is normal, where the short end of the maturity is lower than the long end, that's normal, then financial institutions can make money lending. But right now, they can't make money lending. They're actually losing money when they're lending, because they're borrowing at 5% and they're lending at 4%. Well, they're losing 1%. So why would you lend money? Right? It's going to make you think a little bit. Why are financial institutions lending money right now? Well, they're not, right? I mean, some are, but a lot of them are not lending money because it doesn't make sense. Actually, this started before COVID. People weren't lending so much. But the point is since the financial crisis in 2008, financial institutions have lent a lot less. The standards are stricter, which is fine, right? I'm not objecting to that, but banks have lent a lot less, and that's where they generate a lot of their profit, which we have not been seeing as much lately because banks are finding other ways to make a profit, and that doesn't seem to be in lending. But there's trading and other things that they do. So anyway, I just wanted to point that out, and I think it's really important. I want to touch on another subject and let Doug jump into it, which is soft landing. So if you look at the term soft landing, we're talking about the economy, which is effectively what we've been talking about. The econ we mean the economists and the quote unquote experts in the financial markets. The Fed is trying for a soft landing. A hard landing is what we've typically experienced, which is they raise rates, so the economy gets too hot, they raise rates to slow it down, and then the market crashes, and then they lower rates, and then the market starts to come back. Oh, it's too hot, raise rates, up, it crashes again. That's a hard landing. That is normal for the U.S. Not every country experiences. In the U.S., that is more normal. Um, the Fed thinks it's going to have a soft landing. Oh, it's going to be great. We'll have a soft landing, as Ray Dalio calls it. What is it called? A perfect deflation or a beautiful deleveraging, I think is what he calls it. So there's different terms, but it we the Fed has a undisputed record of not doing that. So they've never got it right. So maybe this is the first time, right? The broken clock is right at least twice a day. So maybe they're going to get it right. But everyone thinking that this is a soft landing means that the public is given up on the fact that they're going to have a recession. They've given up. Everything's going to be golden. We're going to be great. This, in some ways, is a contrarian indicator. Now, if you look at most indicators, when they get extreme on one end, it means that it's probably going to go the other way. So think of a boat. If everyone is on one side of the boat, it's probably going to tip over, right? Well, the only way to right the boat is to go to the other side. And so if you look at markets, what tends to happen is people get extremely bullish, everyone is, and when everyone's bullish, there's no one left to sell, which means that no one's buying, right? You have to have buyers and sellers. That usually means that sentiment changes and then the market turns around, not doesn't crash, but it turns around and goes down. And that changes sentiment and puts it back in the normal range. Same thing with selling. If too many people are looking to sell, at some point there's no one left to sell and then it starts to go up. That's what we call capitulation. So what we're seeing here is, in some ways, a little bit of an extreme where people are thinking, "Oh, it's okay to go in the water. It's warm again. It's safe. There's no sharks. Don't worry about that fin. That fin's that's nothing." Um, so I think what we're going to start to see is we're going to start to see a little bit more churn here. We're going to see a little bit more volatility. We started to see some in August. Um, to me, it seems like that's going to continue. If it continues flat, that's actually probably a bullish sign. So what typically happens when the markets go up and they go to the extreme and it goes too far too fast, the markets have to work off that sentiment. So if it goes sideways, that's actually a positive thing. It means the market's probably going to continue up. It could go down, which I think it'll go back into the range of where we were. That's my perspective, but I don't know. I can't predict the future. If I had to guess, I would say we kind of go back into the range of where we were before, and we get back into that messy middle, which we've been talking about on the show. So I think that's probably going to happen. And sorry, I didn't share this chart, but I'm going to share it really quick and then turn it off and turn it back to Doug. And I want to turn over to China because China's been in the news lately, and I think it's really important that we touch on it. So, all right, that's the chart. And then let's take it to China, Doug. Where do you want to start with China?
Well, I'm gonna start opening with China, just kind of based on a couple of things that I said maybe 2-3 weeks ago. China has finally decided that COVID is at least over for now. Although here in the United States, supposedly it's starting up again. I don't know. I can't keep track anymore. But they finally decided to open their ports, open their manufacturing, to kind of come online. At the same time, they are recognizing that the demand has sharply declined from where it was when the rest of the world started to come out of COVID. And what that's meaning is that China is starting to reel from the effects of having been so isolated, for so long. And I can tell you this, Kirk, just talking to companies that I know that do manufacturing, Some of them larger companies, but most of them kind of the mid-tier companies. There has become a trend that the shutdowns created a problem, right? You couldn't get anything shipped overseas. You had ships sitting out there. I mean, for a while there, they were sending empty ships back. They weren't moving stuff. All right, this caused a real problem. And we've talked about the bullwhip effect. We've talked about many things that came out of the fact that everything was impossible to get, and the supply chain still in a challenged position. Okay. I know you're gonna bring up. We're gonna talk more about China here, but here's one of the effects that I start seeing going on China, and then we're gonna look at some of the data that's out there right now with China, and where does this lead to what could happen to China? A lot more focus has started to go towards getting manufacturing both back in the United States, but also in Central and South America. Okay. Because from there, we don't have to worry about the shipping overseas anymore. We can actually drive things up right through the border into Texas, and right into the country. We've had NAFTA around forever. And so as we go into these numbers, also keep in mind that one of the problems that I think we're going to foresee is not just a cyclical trend here, but potentially a secular trend of a realization that maybe what happened with COVID and the issues of getting things from Asia is something that companies, again, they don't live in a vacuum. Once they realize a problem, they tend to try to fix it. And I think long term, we're going to start to see a changing of attitude towards, or a changing of exposure towards potentially having to continue to rely on what just basically handcuffed so many companies. So let's talk about it. Let's pull up the GDP. What's going on with China right now? Well, China's GDP, as expected, sharply declined significantly and it was already, and look at the trend line. I mean, if you look at their GDP back in the early 2000s, the sharp increase, if you look at it, it was already a trend line that was starting to degrade going into the late teens. But then, of course, COVID came along, 2020, boom, GDP collapse. Again, not unexpected, they weren't working. Okay, now we started to come into 2021, and all of a sudden here you start to see, again, whether it's bullwhip or whatever, the reopening of the economy, a large spike. But now look at what's happening here 2 years out. We're back down to, interestingly enough, well below the average. But if you really think about that average, Kirk, it was padded. Because, for those out there that aren't math majors, an average is taking all of those numbers, adding together and dividing by the number of data points. Well, look at the highs. The highs of China significantly happening in the 80s, minus the recession of the late 90s, early 2000s. But look at late 80s into 1990, and then you get into the 2000s. Look at the trend line. The trend line since then has, as I said, has been declining. And actually, if we take a look at the 2022 numbers, it's kind of still in that straight line of the old trend. So, China's under a lot of pressure. That is not something that's brand new, but you start adding in some of the added variables that we're starting to see in just the way company attitudes are and global economy circumstances. This does not bode well. And again, never trust the numbers completely coming out of China. We all know that. But Kirk, I'll let you, talk about what you see here as well.
Yeah, so I want to talk about a few things with China, and I think this is really important context. Is that China is a different country. I know, but I think we take that for granted, right? Like we use our lens on the world, on the U.S. lens, and assume, oh well, China is different or the same because of how we view the world. China is not the US. China is a very different country and how they run things and how it operates. And, they have this pseudo capitalism, pseudo communism kind of thing going on there. And, it's top down command and control where, if she says, hey, we're going to do this, people are going to do it, right? They don't want to disappear or go to a re-education center or, end up with all the other stuff going on. So it's a different country with different problems and different, different social elements that we have here. But let's put it this way. China's GDP is dropping, as Doug says, right? And that had a lot to do, we talked about this before, about the deglobalization going on. It started before Trump, but Trump obviously had a lot to do with it, right? Because he was pushing for more deglobalization. Because the reality was it was happening, and China was starting to infringe on our power structure because we in the U.S. are in we're still the number one global power, and until somebody unseats us, that's the case. And people when countries with power start to lose it, they tend to do drastic things, and it doesn't end up going well. So the transition of global power will change over the next 50 years. I'm pretty sure, at least the way things are going now, and we're not going to go out without a fight, but we're still going out at some point because it's just the nature of the world. Now, we outsourced our inflation to China starting in the 70s and all through the 80s, 90s, and the early 2000s, and then the 2010s on, we started to pull back a little bit. We started to use other countries. China started to come up in the world. They started to become wealthier. All of a sudden, it wasn't as cheap to do stuff in China. So we started to use Vietnam and other areas we've outsourced. And COVID really accentuated that because we couldn't rely on China anymore. So we started to regionalize our manufacturing, our outsourced manufacturing. So a lot of that's changed. Mexico has become an enormous trading partner with the U.S. Has become much, much bigger, especially since we've becoming detached with China more and more. But the reason we pointed out the GDP chart is to show that when we outsourced our inflation to China, we outsourced a lot of our labor, we outsourced a lot of things, we helped them grow. We were the fertilizer for China's growth. And now we're trying to step back and saying, whoa, all right, now you're competing with us. We don't like this anymore. And so we're changing the dynamics. So we're not outsourcing our inflation to China anymore. We're outsourcing to other areas. Well, the problem is now China is not getting the same growth that they're getting before because we're not driving it. And the GDP is shrinking. And I'm going to show you another chart here, which we found, which I thought was pretty good from the Visual Capitalist. It shows the GDP changes in the last few years. It shows exports. Exports are declining. The CPI, China's CPI is negative. Youth unemployment is skyrocketing. They actually stopped marking the metrics. They stopped counting youth. They just stopped disclosing it because it was getting too high. So there's like, oh, it's getting too high, so we just won't tell you about it anymore, as if that fixes it. And everyone knows it. Everyone's furious that they're not disclosing it. It's a real problem. The U.S. dollar and yuan, and then new loans. So what's interesting is the problem China has, and they've always had, is they have to appease their populace. So they have kind of this communist part of them, and they also have this capitalist part. So they've kind of blended the two in this weird sort of way. The country is very nationalistic, much like we are. The U.S. We're very nationalistic, and they are too, right? So there's a lot of similarities there. Their people love their country, and it's not like they've got some despot up there kicking people's doors open every day. Like some people experience that, but I think overall they love the country. So it's not like a dictatorship like in some countries. But the thing to keep in mind is they still have to appease the populace. If they're not employed, the people are going to get angry. If they don't have jobs, they're going to get angry. If they're locked in their houses for 6 months, they're going to get angry. All these things are adding up. And I've talked to a few people. I'm not an expert in China, but I've talked to a few people who are, and say it's kind of this teapot waiting to bubble over. Like it's really they're walking a fine line over there. And who knows if something's going to set it off or what'll set it off. But right now, some of the metrics are not looking so good. And as Doug said, they tend to manipulate their macro data from the country. We do too, right? I'm not just blaming China. Like we do too. I mean, people would say, no, ours is accurate. Yeah, sure it is, right? I trust all the politicians, but China does as well. And I think a lot of people have measured some statistics that say it's drastically off. And we talked about it, I think, last week in the show of why it's off. When you have a dictator or a president for life, not dictator, president for life says we want 7% growth. Well, the underling's saying, all right, get me 7% growth. And they go down the line. Each subsequent, inferior or underling says, okay, 7%, until the last person who's in charge of a town says, all right, I need 7%. And then, well, you somehow managed to find a way to get 7%. Whether it's accurate or not, I don't know. But when you have people who are demanding hit 7% and you don't hit it, you say, well, we hit 7. I know it was only 3, but yeah, we hit 7. We did it. And, you get a brownie point. But if you don't hit 7, you go to the gulag. It's like, well, I'm going to hit 7, right? Hook or crook, I'm going to do it. So I think the problem with that type of economy is you have data that's not reliable completely when it's being managed. And I think that's part of the problem. Like I said, youth unemployment was so high, they stopped counting it. Well, obviously, they're manipulating the data because they're not counting it. So I think you just something to keep in mind with China. There's a lot of red flags that, and I think this piece was perfect from the marketing standpoint. China's red flag, right? You get the joke. But anyway, so the point is just something to keep in mind. Watch out for China. There's a lot of pieces in there that you should be mindful of. I'm not saying it's going to crash. I wouldn't touch China right here. I just think there's too much going on. The direction is not clear. I'm not saying it's going up or down. I'm not saying it's going to crash either. I don't know. I'm not an expert in China, so I don't touch it, and I don't trust a lot of the companies over there because anything can happen. So I tend to shy away from that. But it's something to be mindful of because as goes China, as goes a lot of Asia, right? If China goes into a deep recession, a lot of other countries in Asia might experience that too. So just something to keep in mind. One last point I'm going to give back to Doug to wrap it up on his end for final thoughts. Is I started to we've all seen the stories. You've seen it on YouTube. You've seen it on Twitter or X or whatever it's called now. You've seen it on Facebook of all these videos of people stealing from stores and no one's doing anything about it. Now, California, and most of these are done in California because California is crazy town or clown world, as some people call it, where they've decided that if you steal under $1,000, they're not going to prosecute. It's still illegal, but they're not going to prosecute you. So, what a great idea. And I have to say, for those of you who thought that was a great idea, you're probably not a listener to the show, so I'm not going to offend anybody. What an awful idea. Hey, we've got these laws, but we're not going to enforce them. You're basically telling people it's not a law, right? It's like saying, well, yeah, I know murder's illegal, but, some people didn't mean it. It was an accident, so we're just not going to charge them. What do you think's going to happen? Well, probably the purge, right? It's something along the lines of the purge where people running around killing each other. It's just human nature is we're going to appeal. It was, I don't know, 70 years ago when people had a moral code and they were bound by certain social codes where they just didn't do stuff. It might not have been illegal, but it was just maybe something you didn't do because the whole community decided it was something you didn't do. And people were bound by that. But as things progressed, that kind of shrunk, and now people are bound by the legal code. That is the lowest barrier that people have to abide by. But if you stop enforcing the legal code, well, now people aren't. They're going to go, well, what can I do? What can I get away with? And apparently, you can get away with stealing under $1,000. So you see a lot of these videos of people running into stores stealing less than $1,000 worth of stuff. They'll go in with like a backpack or a huge grocery bag or a shopping cart, and they'll fill it up and they'll walk out of the store without paying. And people are like, okay. Now, if you're doing it to a small shop, you might get shot, right? If you're going to a local deli and you try to steal the stuff, you might get shot because that's their business. That's their livelihood. If you go into a Target, it's like, well, okay, I'm not getting paid enough to care. So whatever, walk out the door, man. I don't want to get in a fight. I get paid, minimum wage. But, if you look at it, this has been happening for a while, right? Over a year. And so people are getting more bold, and they're just stealing stuff because no one cares. No one's going to say anything. Now, Target came out with a Bloomberg News story that retail executives, and they use Target as an example, are sounding the alarm on in-store shoplifting as theft burns a multi-billion-dollar hole in their balance sheets, and most are vowing to fight back. Well, the only way to fight back is one of two ways. Either you lobby California to get their head out of their butt and actually enforce their laws, or B, you move your stores out of California. Those are their two choices. There is really no third choice. Well, actually, the third choice is you hire armed thugs to stand at the door, make everybody's life hell to keep people from stealing. That's probably not the way they're going because they have so many stores that would probably get pretty expensive and probably there would be other legal implications there. Anyway, the point being is we're starting to see it in the news. This has been happening for a while. And I've been wondering how place like Rite Aid, which you could just go $1,000 worth of stuff is a lot of stuff in Rite Aid. So I'm wondering why those stores are still in California. But now it's starting to hit a lot of balance sheets and people are blaming it. So before things were good, and they're like, whatever, it's slippage. I think they call it slippage, I think was the term that's used. But anyway, so if you see slippage, what they really mean is theft. And this is starting to affect companies in a big way, and they're going to start to point this out. It's starting to be announced in earnings reports. You're going to probably see it a lot in Q4 earnings. People are going to start to mention a lot more. But I mention it because it's the it's a scapegoat because we got bad earnings. It's the theft. Well, it wasn't a theft a year ago when that was happening. Apparently, it's a theft now. So just keep in mind that, and we talk about a lot in the show where there's the story and then there's what's behind the story. Well, the story has been there for a while. It's not new. People have been doing this for a while, and apparently didn't hit earnings, but now it is. So it's probably more to the story than just that. The theft is still happening, but the earnings probably coming from other places as well because it's not a new thing. It's just something that's been going on for a while, and now they're starting to identify it. So keep this in mind. If you start to hear about this, it probably means that there's bad earnings from other areas, and they're just dumping it into this. Not to say it's not a problem. It is, but it's probably also coming from other areas. Like I said, this goes back to my thesis of this quarter. You might just start to see a lot of bad news dumped into one bucket just so they can get rid of it and have good news after that. So, Doug, final thoughts, and you can wrap it up here.
Well, I can't not address that. So, I mean, what you're referring to is Prop 47, which basically made it, a misdemeanor under $950, and of course they can still get up to 6 months in jail. But the courts are like, and the police are like, look, we got bigger problems. It's not even worth pursuing something like that. And it was actually passed as a vote, not a government act, which is really interesting because the citizens of California voted for this. But there is a lot of people here, and even politicians are coming out saying they regret this because it has been a bane. And here's a couple of things. First of all, I don't know if this is true. I don't know if this is urban myth, but I read that one gentleman was, that store owner was raising his prices so that everything in it that gets stolen would be over $950. Now, if you buy the stuff, you can bring it to the counter for an immediate discount for a coupon behind the counter, which is brilliant. I mean, this is this is the stupid stuff people have to do to combat this ridiculous insanity. And the thing is, and this is really what's sad about it, is the majority of people in America are not super wealthy, which means it is, generally speaking, lower income that were a major voting force in this because, of course, they're trying to combat what might have been, police oppression, and harassment. Well, guess what? Guess which areas end up seeing the biggest problems with these theft? So it's hitting them right smack in the face. And for the rest of us, and how is it going to hit everybody, including those people raising prices? If you have $5 billion worth of goods and 1 to 2 billion of it gets stolen, what do you think that means? How do you think the companies come back this? So, that's just another thing that's going into the impact of inflation that it's going to be passed through to you. And ultimately, at the end of the day, you're going to be the ones, and they are paying the price. So we'll see what happens. I know we're getting up on that hour here. So I just want to say thank you again for having me, Kirk. It is almost October. It is, September. It is college planning season. I'm going to just throw this out there. If anybody has any questions, it's expensive. You want to make sure that your child has an extraordinary future, gets in the right school. Maybe have questions about career path. Not sure what they're going to do. But at the end of the day, you just don't want to overcome. What you're seeing in prices is probably close to twice what the real price could be if you do planning. And if you want to be able to have the right extraordinary college and the right price, get the information. Go check us out, procollegeplanners.com. We've got some really good resources for you. And if you have any questions, let us know.
Great. Well, thanks for coming on the show, Doug. And I highly recommend everybody talk to Doug if you have kids getting close to college. It is one of those things where college is getting enormously expensive. And if you can save, tens of thousands of dollars on the cost of college, it's well worth doing that. I don't know how people afford it. This gets into the tail end of the conversation we just talked about with the story about Target. But the reality is, and I'm a little harsh with my language because this is a show about economics. It's a show about investing, and investing comes down to dollars and cents. And if people steal from you, that's dollars and cents. So the reality is, and this gets back into Doug's point, that yes, people are having a hard time. That is without a shadow of a doubt. High inflation is affecting poor people more than most. It's starting to hit middle class people hard. I'm starting to see anecdotal evidence. And of course, this isn't a fact, but anecdotal evidence is a precursor to actual evidence. But anecdotal evidence of people who you wouldn't think are having problems are starting to have problems because inflation is hitting everybody. If you're on the margins, if you're just, our country has very low savings rate, which means that if you get stretched in one way more than expected, like you have to pay 20% more for gas every month and electricity and food, and you're not making any more money, well, at some point you got to make choices. And so the point is we're in an economy right now. Inflation has hit a lot of people hard, and I'm very empathetic to people because the fact that inflation is going on has a lot to do with our policies in this country. And frankly, you could argue whether they're a good idea or bad idea. That's not the point. The point is we had them. We had high inflation. It's still relatively high in many areas, and wages haven't caught up, and that is hitting people hard. So yes, if you can't afford to feed your family, then you might be stealing food. Now, this we say Prop 45 or whatever it was, the California law that went into place, and I think it started out as it wasn't legal to steal. It started out as the prosecutor said, we're just not going to enforce it. That's how it started. They said, we're not enforcing anything over 1,000. Yes, it's a misdemeanor. We're going to ignore that, right? So yeah, we know the reasons why, but the reality is that it's yes, some of them are saying, well, I can do it, I'm going to do it. But the reality is a lot of people actually are struggling. And that's the hard part of this, is that people are truly struggling, and that is not going to go away with anything other than lower inflation, deflation, or rising wages, because people are going to be stretched until that has kind of found an equilibrium. So I think we're going to be here for a while, and this is why I said it's going to be like the 70s. I'm not kidding. And you think it's going to happen right away because our minds we're instant gratification society, and we think things are going to happen immediately. I told you it was going to happen over a decade. So this is going to happen. It's people are going to be stretched for a while, and that's not going away. So I think what people really need to do is they need to really prepare. You need to prepare for hard times, and it doesn't mean they're all going to be hard, but for a lot of people they are. And even if your portfolio is going up, you're a small segment of the population. Most people, their portfolios are not going up because they don't have portfolios. All they got is their income and their expenses. So just be mindful that this is going to affect everything, including your investments. Because if people can't buy stuff, then they can't pay revenues to these companies that you own, which means that they can't pay their people. Their earnings drop, which means their price drops, which also affects you. It's all interrelated. So taking this back home, we're going to wrap it up here. But I just wanted to point that out because theft is a real thing. It's going to start to impact more and more people, and you just need to be mindful that everything is interrelated. It's not just the poor people who are suffering. It's going to filter through the rest of the economy, and I think only the ultra wealthy will probably be sitting on cloud nine, but everybody else is going to suffer when they're going to take it out on the wealthy because they're going to blame them for their challenges, when in reality we're all personally responsible, right? We're all personally responsible for outcome, and I think we just need to be mindful of that. And what I mean is not to point blame. I say this because it's your responsibility to take charge of yourself, and now is the time to do that. Times are not dire, right? We didn't have a stock market crash. We don't have 20% unemployment. Times are not dire. It is time to take control of your financial life. Start here by listening to the show. Learn about investing. Learn about personal finance. Improve your financial situation. Cut costs. All the things you need to do. We talk about it in the show every week. It is your personal responsibility to do that, and I charge you to go do that. Right? It's up to you. At the end of the day, you can't blame anybody else. It's up to you, and whether you're in a good situation or not, that's a different point. But you are still in control of your situation, right? And so take this opportunity to do that. If you have questions, send us questions. Happy to answer them on the show. We love educating people. We ask nothing in return. We're not charging you to listen to the show. We don't have advertisements in the show because it's not about the money. It's about educating people and making people better. That's why we're here. So hopefully everyone takes that and takes your own responsibility in your own hands. And if you have questions, like I said, we're here to help. And that's an offer. So we're here to help. If you have questions, ask. Anyway, so that's the show for this week. Thank you for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisory Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast on the podcast app of your choosing. You can also check out our show at moneytreepodcast.com. On our website, you'll have access to the show notes, resources, and the archive shows. Lastly, please leave a shorting and comment on the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send him an email, express your feelings. If you're seeking financial advice, talk to an oracle, or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.